If you can't finance the deal, you can't keep growing. For the very first time, I'm going to put on my former CBA branch manager hat and pull back the curtains on 3 lending traps I used to see investors fall into all the time. Knowing what these 3 traps are could make the difference in millions of dollars for the success of your long-term portfolio. I'm Arjun Paliwal. Let's go. Starting with the first trap, but before I get into it, you don't want to miss out on the last lending trap, which I'm going to mention towards the end of this episode, so stay tuned. Now, with the first trap, what it is about bank versus broker. And you might be thinking, hold on a minute, Arjun, you are an ex-banker, you were ex-branch manager in the banking days. I was. But then what many people don't realize is there are waves of borrowing capacity difference between one bank and another. And when people would go into a branch, whether it be CBA, NAB, ANZ, any bank really, if you go into that, you're only going to get the capacity of that bank. And maybe it is one that does a lot for you, but what happens if it's not? How will you truly know? And so what's been really rising in popularity in recent times has been using a mortgage broker. And for those who are new to it, it's essentially you having access to 30 plus lenders, different banks with different borrowing capacity calculators. What that could do for you is the difference of hundreds of thousands of dollars and sometimes even over $1 million just based on the servicing policy that some banks will have versus others. Now, when you're looking at different banks, yes, there might be variances in interest rates they provide you, fees they charge, and of course the big one, borrowing capacity you get to expand a portfolio. But when you do go down those pathways, like higher interest rates, for example, many think that that's going to be that bank forever. A savvy mortgage broker won't have that happen. When they see you have a loan where you've had to take it out to get that extra property, and it's with a bank that charges more in interest, imagine you could start planning your exit strategy. And with your exit strategy, it's basically talking to that broker in this way. Hey, I know you got me that property approved for a $600K purchase price. Call it a 90% loan. And my current bank wasn't doing that. That offers about 0.5% to 1% cheaper in interest rate. What would my income need to be able to actually refinance that loan back to that other bank in the future? And so now you could break that income up in rental income rise, salary or business income rise, or additional income streams. All that income that you're doing now is a target. And when you have a target, you can reverse engineer how to get there. It might take 3 years, 6 months, 12 months, that depends. But the main thing is when you have an exit strategy planned, you don't intend to be with that high interest rate bank forever, but at least it got you that next place. So that's where just by being with the bank first broker, you can plan more scenarios, you can get more options, and as a result, you're able to grow your portfolio further. Now, one thing that's common when dealing with bankers is they actually end up wanting to have the portfolio tied in the most simplistic way possible. And this is a term called cross-collateralization. In simple terms, what this means is when they actually grab multiple properties and secure them together under one loan structure in the back end. So on the front end, you might see 4 different loans. You've got 4 different assets for 4 different properties, and it all seems normal. But on the back end, their securities are tied to each other. Why do bankers do this? There's 3 core reasons. Firstly, they do this so you can actually have simplicity in your approvals. For example, if you have $1 million property and it's got a loan of $400K, 80% of that $1 million property is $800K. So there's more than enough equity in that property for you to buy another $500K property. Let me explain real quick. Another $500K property with a $400K loan, say 80%, that has $100K remaining of deposit and costs on top. And for simple numbers, we're just going to call that $150. Now, normally you'd have to put a 20% deposit down if that's what you're going for, if not 10. And then normally you'd also have to pay extra costs that total, for this example, up to $150K. But instead, you've got that property worth $1 million, which is your other property with only $400K owing on it, and the bank can tie the 2 properties up on the back end and just give you a loan of $550K for this new property, which now funds you for the 100% of the purchase price and funds you for the cost to purchase. So you've essentially used no money. So the first thing is simplicity for them, simplicity for you at the starting point, which is I've got a loan for property 2 and it covers all of it. And I've got a loan for property 1 and the values combined and the loans combined are still within or below that 80% number. So that's the simplicity part. That's why they first do it. The second part of why they do it is that from a tax deduction perspective, instead of you having a loan of say 400K against a 500K property, your loan is the whole purchase price now. So there's more deductible interest rate. And obviously check with your accountant that that's all above board. But the main thing is that's your deductible interest rate in the banker's view. So it's higher. So therefore they can give you a little bit more servicing, or you can also have more tax deductions as part of it. The third scenario of why they do it, it's easy. It's quick. You don't have to order valuations at times because you've got lots of equity. So it's also all taken care of. You don't have to do as much work on the file because it's just easy. You don't have to separate equity loan, separate new purchase loan. All just becomes nice and quick. You don't have to worry about all the banking and admin. So you can see why they do it. But is it good to do it if your whole portfolio is tied up? And to remove these structures and refinance against banks, you've got to do multiple valuations, pay multiple fees potentially, and redo a lot of paperwork. And there is a chance that the bank may not release some things unless you pay down certain loans, bringing more complexity to the picture. So that's why sometimes alongside the borrowing capacity changes, you should consider the bank versus broker. And in many cases, the broker wins. Now you might ask me, where has the banker won in your scenario, Arjun? Hasn't there been certain ways that you can not have this trap occur and you don't have to go down the broker path? Well, I can give you a few ways. So 2 scenarios I've seen often is that there are certain banks where they're just speed-wise, no one can beat their speed because you've got their bank account with them, your pay goes into that account, you've got no bank accounts with other people, no loans, no credit cards with other banks. So they instant approve you on the spot for a pre-approval or a property purchase, like instantly. So no wonder with convenience, people go, I don't even want to think about it. Instantly, I got the deal done. So that's an example of where it can win. Another scenario is where you might be a very high net worth client and you go into the world of private banking. In private banking, the banks have a direct queue so they can make things faster for you. They can look at the rules a little bit more from a gray format rather than a black or white because of complex structures and income receiving structures that many folks with high net worths and higher income have, or complex business entities. So as a result, they can be tailored policies and things that actually help with your lending and actually growing that without having to go to a broker. So that's me giving the banks a bit of love, but let's call that trap number 1, which is just not knowing your options, bank versus broker. Trap number 2, this is about the entities in which you buy the assets in. So this will require a bit of teamwork between your broker, your actual accountant, and obviously yourself. And what's involved is how you can buy properties in different entities. It's important to get personalized tax advice on this because each situation may differ, but this can contribute to a lot of lending growth. I'll always look at my own situation, for example. In my own situation, I've got some assets in my personal name, and these assets were there because I didn't think at that time that I would be buying a lot of properties. And also, some of these assets are my home that I live in. Or other scenarios are there assets that have a really solid land tax threshold in their respective state. Example, New South Wales, an $800K to $1 million in land value. And that's a very big land value number that you can use. So you can actually end up buying a property in there and not end up paying land tax on a property until it reaches a certain threshold. But then the majority of my assets sit in what's called a family trust. Now, when they're in a family trust, they allow me to build up this pool of assets. And by being in that pool of assets, the banks can look at excluding the assets within one family trust. So I'll give you an example. If I have a family trust with 5 properties in it, and this family trust has 5 properties that are all at some point either neutral or positive cash flow. They don't get to that from day one. They take time through rent increases, money and offsets, and also from time. That just means interest rates might not be as high as today. Then when they're all positive, the accountants can write a letter to the bank to go, hey, this person is buying in another entity, not that trust, a second one. And all those things in the first trust are positive, meaning they're covering themselves. It's like an entity that is self-sufficient. And if that's the case, Bank B can ignore those liabilities under that separate trust from Bank A. 3 things to consider with the strategy though. Not every bank does it where they ignore the other liabilities. Number 2 is a lot of assets, if not majority purchased today, will not be positive cash flow, and you need to be patient for the cash flow to reach positive for your accountant to sign it off. And number 3 is in chase of the serviceability, you might actually have a lot of disadvantages by having taxes in that not deductible. So for example, if you have a negative geared property on one of the assets, you may not be able to deduct that against your personal income because tax deductions in a trust stay within the trust, not you personally. Whereas in your personal name, you would have had that deduction come through so you can deduct against your income. The second thing is you may pay more land tax costs in certain trust structures in certain states. And then the third part is you'll likely have more management costs with accountants and more annual fees with the accountants. So all of these admin costs add up. The lack of tax deductions add up. And then as a result, the land taxes and the costs within each state add up. So these are some of the reasons of why you wouldn't do it. But to make sure you should or shouldn't, get some advice from your accountant to consider this. However, the big thing you can see is that when you do have debts in it, you can have excluded when it reaches profitability. The accountant comes to the party, the broker comes to the party, and they both convince the actual bank that this is okay to be left alone and let's just focus on a new trust. So all of a sudden you had 5 properties there that are ignored. You've now got the ability to add another 5 in the entity structure here. But it's really important you can manage them. That's a key, right? You don't want 5 properties here, 5 properties here, and they come across as positive with some instant calculations or some funky calculations, which you really don't want. And then you've got 10 properties that you can't hold that are truly negative and they're hurting your pocket. So that's the last thing you want to do. Sometimes people talk about all the structures, but they forget that the actual structures need you to hold the assets too, and you need to be able to hold it. So it's not just about the potential of this lending factor that you want, but you actually also have to know that you can hold it. So that lending trap is actually you buying all your assets indefinitely in your personal name. And that's one way you can avoid it, through considering structures with accountant advice. Now, it's number 3. I said stay to the end for this one. This is all the simple stuff, but it actually ends up grabbing many people. So the simple stuff is credit cards, overdrafts, car loans, student debt, and alternate types of income. So let's go through these. If I go through the credit cards, the banks typically think that your whole limit is being used, not what you've paid off or not what the balance you have on there. So they put calculations in play to think that you're a wild spender and you're just going to, red 21, pulling out cash advances from your credit card, and you're popping it out onto that and filling up your limit to the max. They don't care if you pay it down all the time. The second thing is car loans. Car loans, you might be able to, say that, hey, no, this repayment's not too much, I can handle it. But they put loading percentages on car loans, which essentially mean that they say that the car loan repayment's more than what it is. And if not that, many banks also will just add that to your servicing calculation, and that's going to reduce how much you can borrow. Because car loans loan terms aren't your homes that are on 30 years where the repayments are much smaller. The repayments are decent because they're typically over 3, 5, or 7 years. So where you can, do your best to get cars with cash. So on the car part, I just want to say one more thing. If you love cars, go for it. Enjoy it. But I think you have to separate it from your portfolio goals if you're not in a high income business ownership position. Because when you're on your portfolio goals, really smash that out. And then once you feel you've achieved your acquisition strategy, you can move over to getting those nicer cars and car loans if that's important to you. Alternatively, there's even some people who look at their home equity and use that for cars. And they stretch out the repayments and it becomes much cheaper. Now, me personally, I had my car in, I think, just around COVID time. And that car was $1,000. It was a Mitsubishi Pajero. Broken windshield, still broken, a little bit of a crack on there, got to get that fixed up. But the Mitsubishi Pajero was $1,000. My dad chucked in an extra $1,000 to fix it up, maybe $2,000 max, and at a grand total of $3,000, I'd used that for many years, until recently where it hasn't been trotting along. And that's when I got the latest car. But even that latest car that I purchased was cash purchased. So the power of that is it didn't impact my servicing negatively. So that's a couple of things on the cars to think about. Now, overdraft, student debts, much like liabilities here, on the credit card and car loans, they impact you negatively. But with student debts, it's interesting. It's not just the debt amount, but also how much you earn dictates the percentage you pay back. So if you're a higher earning person, the percentage you pay back to your student debt is higher. Therefore, just by being on a better whack in income, it actually has a greater impact on your student debts. And so from that perspective, I would say that, hey, if you can, not everyone can. I followed a strategy that was pretty unique, where I did a bit of studying, went to the workforce, stopped studying, earned some money in the workforce, and then after that money in the workforce, when I was in my career of banking, I used cash to pay for my studying. So I was able to build a portfolio with no student debts. And that allowed me to really progress ahead, so I didn't have things chewing away at my borrowing capacity, because I was able to spend that money on my MBA and not have to pay for it from student debts. I use my own cash. Now, that doesn't happen for everyone because I know it's the chicken and the egg. Go to work to gain experience, but where's your degree? Go to get a degree, but where's your work experience? That's the most annoying thing in the workforce. But the main thing is just know that there are ways around it, like I just said with my own journey. And so when you're looking at all of these, the final one is your income. You think that when you're getting a bonus or a commission or overtime, or you're getting great rates on casual, or you've got strong rental income increases, not all banks look at the same. Some banks need you to look at it from a 12-month average. Some banks want 2 years. Some banks actually look at it from 80% of the income. So if you had a bonus of 100K, they might only take 80K of it. Some banks will look at 70, 80, or 90% of your rental income. So they won't look at all of it. So these are just some of the things to think of when you're looking at it, that the bank won't review it the same way. I'll give you a bonus tip. The actual owner-occupier home loan, they don't look at it the same as renting. So if you've got a home loan that has $1,000 of weekly repayments, many banks look at that as $1,200 of weekly repayments because it's called debt loading. Whereas if you have $1,000 of rent per week, they look at it as just $1,000 of rent per week. Interesting how that works. You're penalized by up to 20% with some banks simply because of having a loan that's actually for a place you live in. And so these are the 3 lending traps to avoid. If you can avoid just solely focusing on one bank and actually learn about your options through Bank First Broker, if you can ensure that you're considering the different names and having your accountant help you on their guidance as well of structuring your portfolio. And then third, if you can consider all the micro decisions, the credit card for the points, the travel, or the car loans, the overdrafts, the student debts, and even just your income sources and how they come through. All of that together can help you unlock a lot more lending and actually build a larger portfolio. And if you're in your acquisition phase, a larger portfolio, not just in value, but frequency of properties is important. So when you're building a portfolio, you can figure out what to consolidate, what to keep, and you have more options to choose from. Obviously, all of that's going to help your lending. Nothing's going to make the difference as much as professionally focusing on increasing your income and growing your career. But all of these 3 traps here, or these 3 things to avoid and what to do instead, can help you grow your financial future as well through just getting more leverage and adding it to your portfolio. And of course, don't forget to subscribe to help our channel grow and put out more videos like this.